Jeff Dennis now. Of course, he's been tracking emerging markets for really a while now. Jeff, what's your approach as far as global weakness and high volatility is concerned in this first 2-3 days of trading session for this year?
Are now pretty much close to pricing in an outright recession in the U.S. Of course, as your listeners will know, once the yield curve starts to flatten and even inverts and with lower bond yields, it's all consistent with worries about recession. I suspect the U.S. economy is going to slow very sharply in 2019, but I doubt we're going to have a recession, and therefore I think this selling pressure on equities globally will subside relatively quickly because the market's pricing in a fairly negative scenario now.
Jeff, I just want to get in your perspective with regard to the emerging markets. Do you think EMs will actually end up outperforming developed markets? And specifically for India, what's your stance?
I certainly think they are a better investment. A lot of people have the view that because emerging markets didn't sell off as much in the fourth quarter as the U.S. did and developed markets did, emerging markets are ready to go down. I think you've got to look at 2018 as a whole, and EM had a very bad year. We started to sell off way back in the beginning of at the end of January. So I think you've seen some widening of the valuation discount that EM is trading on versus the developed markets. I also think that you've started to see in one or two places perhaps some slightly more optimistic outlooks for the economy and, of course, potentially for politics. You look at Brazil with the new president, coming into office, etc. I think on the emerging market side, nonetheless, I think the biggest worry here now is probably the speed of the Chinese slowdown. We've seen two important data points this year. One was the PMI data for China at the beginning of the year, and then, of course, we've had the revenue warning from Apple. So I think the biggest risk to markets now is we get a more severe slowdown in the Chinese economy than perhaps everyone has been expecting. A sharper slowdown would not be good, I think. But again, I think there you're going to get continuously gradual slowdown rather than a sharp slowdown. If my view is correct that emerging markets here form a base before too long, sometime in the first quarter, and have a better recovery and have a better period of time after that, I think India's probably going to underperform, or it's not going to outperform. India's held up very well, of course, in the fourth quarter, and you've got the elections coming up, plus you've got the fiscal risk in India. So my scenario here is no U.S. recession, no major Chinese collapse. Markets start to bottom out. EM beats DM in 2019. We start to see EM beginning to recover sometime in Q1, and India in that environment probably underperforms.
And Jeff, what's your projection for other asset classes like treasuries, the US dollar, gold, and even oil for that matter?
I think, as I say, I think emerging market equities will outperform developed market equities, although I do think that the U.S. market is probably close to the bottom as well. I think that the issues that you mentioned there about Brexit, for example, and of course Europe had a terrible year last year. I think Europe has got tremendous, growth challenges, and of course the Brexit story is still there, and no one knows how that's going to play itself out. And of course, not only are the Italian government fighting with the Commission over their budget deficit numbers, or so maybe the French government ultimately as well. So I'm very skeptical about Europe, but I think the US is probably not far from a low point. But I prefer emerging market equities, and I think some of the gains we've seen recently in places like Latin America and parts of emerging Europe, they're probably going to lead the way taking 2019 as a whole, until we have a better sense of where China's going. Because if China really does start to settle down in terms of the economy and the slowdown begins to ease, Asian shares will eventually have some sort of recovery. But right now, the risks to the global economy are from the U.S. economy, are from China, and therefore, of course, are from the trade war between the U.S. and China.
Right, that was about the asset class in 2019, which you just said. But, we were earlier asking you about projections for gold, oil, U.S. Treasury. What would be the allocation to that, if any?
Well, as far as the dollar's concerned, I think the dollar's overpriced. I think it's going to come down, and of course, traditionally, that's very, very helpful for emerging markets. And so, I would expect to see the dollar going lower. I think Treasury yields, if we don't have a recession in the U.S. economy, are probably close to their bottom. But I think it's going to take some time for those yields to back up again. I mean, you're getting help already at the margin for the U.S. economy from the lower mortgage rates, which are coming through. Also, I think we're very, very close to the Fed actually stopping their tightening campaign, which I think is probably very likely. So you may see bond yields go a bit lower, but I think by year end they'll probably be higher if my view here that there's no recession will come to pass. And I think if we get some better news generally on the global economy, taking 2019 as a whole, we eliminate some of the recession fears. I think commodity prices would make some sort of recovery.
Right. Thanks so much, Jeff, for talking to us and giving us a view on the emerging markets and what's the way ahead.